Welcome back, everybody. Earnings season is in full swing, and three more of my companies reported quarterly results last week, and that includes Alphabet, or better known as Google, Caterpillar, and Valero. And the results varied from up big to down big to pretty much nothing at all. But as we know, the price is just the price, and what we want to know is how are they actually doing as a business compared to our expectations as investors. So in this video, we're going to review Google, Caterpillar, and Valero's earnings results, discuss why Google's earnings are actually better than you think, and see how Caterpillar and Valero, two of my top 4 stocks for 2024, are actually doing versus my expectations. So let's go ahead and get started. Now, Google stock jumped over 10% after hours after announcing earnings, and there was a lot to like. So first off, they announced that they're initiating their first ever dividend, which is what most people attributed to the huge bump in share price. And I'm sure that helped, but there was a lot more to it than just that. Now, revenue was up 15% year over year compared to being up just 3% a year earlier. And operating margin jumped 7 percentage points from 25% to 32%. And earnings per share jumped 60% year over year. And remember, this is a $2 trillion company, so that's pretty remarkable. But Google's earnings were actually even better than they looked on the surface when you looked at some of the actual details. Because while revenue was up 15%, the even better story was where the growth was coming from. YouTube revenue was up 21%. Their subscriptions, platforms, and devices revenue was up 18%, and Google Cloud was up 28%. And in the earnings call, Google CEO Sundar Pichai says they expect YouTube and cloud to be at a combined $100 billion run rate by end of year, which means they expect it to be around $25 billion combined, up from the $17 or $18 billion it was this quarter. Now, that's a 38% increase from where they're at in Q1, so that's pretty exciting by itself. And the reason why the growth in those other segments is so important is many people believe that their core search product is the one that has the most chance of being disrupted by things like AI. Now, I take a slightly different view on this. There's obviously a chance that happens, but I think Google's stranglehold on search is way stronger than people are giving them credit for. And even just minor integrations of AI into their existing search experience, which they're already doing, is going to be more than enough to keep the bulk of users where they are. But in addition to their revenue growth, their operating margin took a big jump as well, going from 25% last year to 32% this year. So at a high level, they're earning more revenue, they're converting more of that revenue to profit, and those are both good things. And they made those profitability strides both in Google Services, which went from a 35% margin last year to a 40% margin this year, as well as Cloud, which has been slowly growing to profitability and had just a 2.6% margin last year and now around 9.4%. And I imagine that's still growing. And then in addition to all that, the big news was that Google was planning to initiate the first ever quarterly dividend of 20 cents a share, which of course made Google everyone's favorite dividend growth stock basically overnight. And I talked about this possibility when I added Google to my portfolio earlier in the year. In this case, it just so happens that Google doesn't pay a dividend, at least for today. But as we saw with Meta this past quarter, that can change pretty quickly. With Google going up over 10% after earnings, the market clearly likes their latest earnings release and their outlook. But let's take a look at my initial analysis to see if it lines up with what we're seeing from Google's business. Because this was a story I had when I added them to my portfolio. All of these things are still true, and I would say in general, they're either unchanged or slightly improved from when I first looked at Google. So the story is still the story for now. Now, if we take a look at what I'm actually monitoring for Google, revenue growth is obviously good and accelerating from last year. In terms of search versus other segments, that's been a positive with YouTube subscriptions and cloud actually gaining on overall search, but search still growing in double digits. Their market share across all platforms has been strong. In terms of cost, we know that their operating margin improved by a bunch, plus they reduced their workforce by over 5%, as well as having stock-based compensation at its lowest level in the last 5 quarters. So all of those things are positive changes in the right direction. And then lastly, the regulatory changes are still TBD, with the DOJ's case not resolved, but Google has asked a judge to throw it out completely, so we'll see what happens. And just real quick, if we take a look at the risk that I outlined back then, in terms of AI disrupting search, again, I think that is further away from being a reality than people think, and Google has already started integrating Gemini features into their core search product as it is. We talked about efficiency and cost, and Google seems to be making good progress in that area. And then lastly, regulatory and labor concerns. We touch on the regulatory concerns being still TBD, but with labor issues, there's actually been some recent news, and in my opinion, it was positive. Now, you guys probably heard about the 28 Google employees that went into the CEO's office to protest or whatever, and well, those employees were fired, and in some cases, they were even arrested. And honestly, to me, this is a step in the right direction for Google, and I'm not here to argue about the cause. People can have whatever opinion they want about that. What I liked about Google's response was that they basically drew a hard line and said, look, this is a place of business, this is a business workplace, and this type of behavior is just not going to be tolerated. And in general, I agree with that approach for companies. And that's regardless of whatever the specific issue is. And specifically with Google, I think they have a history of being pretty soft on their employees. So hopefully this is a step in the opposite direction and getting back to focusing on what matters for their actual business to be successful. But only time will tell. But in terms of the stock, I think Google is a great example of how people can make up narratives about a company and people just start to accept it as truth. Because just a month ago, all you heard about Google was it was in decline. They were behind in AI. Gemini was a disaster and search was going to be disrupted. And Sundar was a weak leader and whatever else you heard. But now they're doing great. Things are looking up. The market loves the stock again. But if you look at the things that I was monitoring and the risks that I outlined, they seem to be the right things to be able to tell if the company was doing well or not, regardless of the price and regardless of the narratives in the market. And I think it's pretty safe to say at this point, they're doing very well. Okay, let's move on to Caterpillar. Now, Caterpillar was down over 7% after announcing earnings, where they beat on earnings per share but narrowly missed on revenue, while also saying that they expected revenue in 2024 to be roughly the same as it was in 2023, while analysts expected it to be slightly higher than last year. So most people viewed the sell-off as being related to their weaker forward outlook, and that might be part of it, but I think as we dig into this, we'll see that it was probably something much more simpler than that. And so if we take a look at their earnings report, we can see that while their revenue was down just a bit, their adjusted profit per share was significantly higher than a year ago. And in this case, we're talking over 14% better. In addition to that, they returned $5.1 billion to shareholders in forms of dividends and share buybacks, with a whopping $4.5 billion of that being share buybacks in the quarter. And their operating profit margin jumped from 17.2% a year ago to 22.3%, which is a pretty nice improvement. But let's take a look a little bit deeper to see kind of what's happening with their revenues. If we break it out by segment, we can see that construction and resource industries were down year over year, while energy and transportation was up. And this part should be expected with Caterpillar because they're a cyclical stock. So the revenues are going to ebb and flow with just whatever's going on in different industries or around the world. And that's something I talked about in my initial analysis of CAT, and overall their diversity of revenue both in industry and geography being a positive. But it means you will have some variation from quarter to quarter because things are constantly changing throughout the world. Now, obviously, the construction segment is a big one for CAT, so if it continues to decline, that may be a concern. But at this point, they're still maintaining their outlook for the year, which was overall revenue about the same as 2023. And that wasn't actually new guidance. That was what they officially announced in last year's Q4 earnings call, and they actually hinted at it in Q3. So if that's the case, why did Caterpillar actually drop 7% after earnings? Honestly, I think it was simply people taking profits on a stock that's been pretty much up only for the last 6 months. Because CAT was up about 60% since November, with 17 of the 23 weeks being higher. Combine that with the fact that revenue was slightly lower than the year before, and construction segment revenue saw a decline, and Caterpillar was finally approaching their 5-year averages in terms of price to earnings and price to cash flow. I'm guessing people thought that it might be a good time to lock in their profits and look for something else. Because remember, not everybody is a buy and hold investor. And of course, it's impossible to know if that was the real reason, but based on what I see in the earnings report, that seems to be the most logical. Now, if we look at what my original story for CAT was, the revenue slowed down at least for this quarter, but at this point, they've reiterated their original guidance that it would be similar to last year. Their diversity in revenue is obviously still a strength. Their margins continue to improve in the quarter. Now, their revenues are cyclical, and that might be part of what we're seeing in terms of revenues being flat for 2024. But to be fair, Caterpillar had their largest revenue year ever in 2023. So just because they say they expect it to be flat in 2024 doesn't necessarily mean that it's bad. Still, at some point, you would expect their revenues to decline a bit in the normal economic cycle. Overall, though, the story still seems to be very well intact. Now, if we take a look at what I'm monitoring for CAT, the revenue growth is obviously flat to slightly declining for the quarter, but their margins are improving, and the cash flow is actually still up in the quarter from the year earlier. And in terms of dividend growth rate, they've maintained their dividend, but the normal increase timing will be in the June announcement. So we'll see here in a couple months if they increase their dividend and by how much. Overall, CAT is doing exactly what they said they would do, so I don't really look at the 7% haircut as anything more than a healthy correction for a stock that's been pretty much up only for the last 6 months. Now, if you're not a buy and hold investor, then it may be time to look at CAT and consider whether it's going to reach that normal cyclical down cycle anytime soon. As for me, I'm planning to hold on to it as long as the story stays intact, and for now, it definitely is. All right. Lastly, let's talk about Valero. Now, Valero basically did nothing after earnings, starting the day at $167 a share and ending it at $167.13 a share. They pretty handily beat on earnings, but missed on revenues by over $1.3 billion. Now, because Valero is an oil refiner, missing on revenues really isn't that big of a deal because it's really heavily tied to oil prices, which is obviously outside of their control. And if we take a look at their earnings release, we see that they also returned $1.4 billion back to shareholders in the form of dividends and stock buybacks, with over $1 billion of that being in the form of buybacks. And Valero is an interesting company because the fact that their industry is so volatile and that they're a refiner means that their revenue, their income, and their cash flow is going to fluctuate as gas prices, demand, and oil-related conflicts fluctuate across the globe. So it's not a company where you would expect to see consistently rising revenues and cash flow, like it's going to go up and down. And it's more about continuing to be as efficient as possible and beating expectations on a quarter-by-quarter and year-over-year basis, as opposed to just expecting steady, ever-increasing growth. And if we look at my original story for what Valero was, strong cash flow generation is still key, and while it's down from a year ago, they still managed to buy back $1 billion worth of shares in the quarter. In terms of improving margins, they've been going up for the past couple years and in a slight dip over the last 2 quarters. But their management team did mention that they've been doing a heavy amount of planned maintenance on their refining system. So I would expect those to continue trending up over time. In terms of capital allocation, obviously they returned $1.4 billion of the $1.85 billion that they generated in the quarter back to shareholders in the forms of dividends and share buybacks. And while they've had a historically low valuation, especially when I started buying, that's changed a bit with the combination of Valero's price going up and their earnings coming down from last year. Now, they're still slightly below their 5-year average for price to cash flow, but it's almost double from where they were last year. And finally, their questionable long-term prospects and high volatility. At the end of the day, this is due to being in the oil business, so it's something that you just kind of expect and deal with as an investor. It's also the reason why I trimmed a small portion of my Valero holding a few weeks back just to put those funds into other attractive opportunities. And then real quickly, if we look at the things I was monitoring for Valero, it's all the same stuff we just talked about: cash flow, buybacks and dividends, and valuation. So overall for Valero, it's chugging along. Like, it's never going to be this crazy compounding company where revenues only go up. But they're a company that's very well managed, they tend to beat expectations, and they're committed to distributing profits back to shareholders. So it's doing exactly what I would expect in my portfolio. So how are your stocks doing during earnings? Any big winners? Let me know down in the comments below. Now, if you want to see my original thesis about why I added Google to my portfolio to begin with, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.